Dividend yield and PE ratios. Doesn't get more exciting than that, but we're going to talk about it here today because it's important when factoring your valuations of your stocks and what you think you can get from them going forward. We're going to have a two-part series on John Mauldin's. He did a couple articles on stock return is determined by valuation. And I completely agree with this. 100% take issue with a different area of John Mauldin's thing when Social Security won't provide enough for many retirees, and I totally take issue with that. But in this case, 100% agree. John talked, and Ed Easterling had do this joint article here, and I want to share with you a book I got from Ed Easterling called "Probable Outcomes: Secular Stock Market Insights." Man, such a good book. Tons of stuff. I read this like crazy, highlighted it like crazy. Just tons of highlights in here. And if you want to get the book, I'll put it in the show notes. And of course, if you buy it through my link, I get paid a commission, 4%. So go ahead and buy this. Get the hard copy because you want to at least get a paperback. Don't get the Kindle because you want to make sure you can highlight it. It's critically important if you understand this, my friends. All right. The price-earnings ratio, PE, has a multiplier effect on stock returns. Over 10 to 20 years, PE can dramatically increase or decrease, resulting in a significant addition or reduction in total return. 100% agree with that. Okay, bear with me here. We're going to make this, you'll understand what I'm talking about if you're not yet. Don't hang up. Hang in there because this will make sense here in a second. In the secular bear market of the 1960s and 70s, the decline in PE virtually eliminated the return from earnings growth and dividend yield. In the 80s and 90s, the increase in PE more than doubled the return for many of the decade-long periods during the secular bull market. So what's happening here? If you have a price-to-earnings ratio to start the decade at 10, let's do this. So PE means for how much are you willing to pay for every dollar of earnings of a stock? Does that make sense? Incredibly important to understand this. The price-to-earnings ratio is the number one mechanism to determine future returns. I'm willing to pay 10 for every dollar of earnings in a stock. I'm willing to pay $10 for every dollar of earnings. All right. Historically, it's been about 15.5. So if we start the decade with a PE ratio of 10, all right, and then we end the decade with a PE ratio of 20. So our price to earnings ratio has gone up, was doubled. So now I'm paying $20 for every dollar of earnings that the stock is making. Does that make sense? All right, so that simply means basically someone who bought at 10 has doubled their money on price to earnings alone. And that's all there is to it over those last 10 years. Has doubled the money. That's been very, very good to this investor here who started at 10 because now other people are paying double for that stock relative to the earnings of the company that issued the stock to what that guy did initially. Man, I know that's a lot. I want to see if I'm explaining that right. I'm paying $10 of earnings for every $10 for every $1 of earnings in 1980. We'll just say. Fast forward to 1990, and you're paying $20 for every dollar of earnings for the exact same company. So I bought it at 10 and I sold it at 20. That's how it goes in this regard when it comes to PE ratios. All right, I hope that makes sense. And the reason you're willing to pay 20 for every $1 of earnings, because you think you can turn around and sell it from 20 to 30. I mean, that's what your thought process. Your thought process says, hey, if I'm willing to pay 20 for every dollar of earnings, maybe someone else will be willing to pay 30 for every dollar of earnings. Or you might think the earnings will keep growing. The earnings are going to grow more and more and more and more, so that the price to earnings ratio stays at 20. But the reason for that is because the earnings went up like going crazy, like a rocket ship. So you're thinking when you pay 20 for every dollar of earnings, one of two things are going to happen. This is what you're thinking. Nothing else matters. The earnings will grow exponentially, which will keep the price to earnings ratio flat, or there'll be someone else who's willing to pay more for a dollar of earnings than what I paid at 20. And Amazon's a perfect example. In fact, let me pause real quick and see what Amazon. All right, so let's look at Amazon, for instance. Here, their PE ratio is 87. That means basically someone who's buying the stock today is paying $87 for every $1 of earnings. And that might seem high. It is exorbitantly high, without question. But I will tell you, was it 2 years ago when Amazon made its first profit? And I remember thinking this is, I remember myself thinking this. That was bad because it showed how high the PE ratio was, because they actually had earnings. And if you have earnings, that will show you how high the PE was, because their earnings were low, but the stock price was sky high. And I remember the PE ratio at that point was like 900. If they don't have earnings, you had no PE ratio because they had no earnings. So it's actually worth, I mean, I'll never forget that. It was actually kind of funny. No earnings, no PE ratio. Thus, you can't get a gauge of how high the price is relative to the historical norms of PE. So it's kind of a facade. Once they started turning a profit, that meant that it showed the PE ratio is quite high. But look at this. So in this case, the PE ratios dropped significantly from what it was like 2 years ago, because the earnings have gone through the roof. That's just what's happening. However, the PE ratio is still exorbitantly high. Does that mean it's not? I wouldn't buy it, but does that mean you shouldn't? No, I don't know. But I mean, that's how it works. So that's what happens with PE ratios. You're buying it at 20. You're paying $20 for every dollar of earnings, under the expectations that their earnings are going to grow so much that your PE ratio will be flat, or it'll even go down because the earnings grow more than the price does, if that makes sense. Or secondly, that there'll be, I hate to say the bigger fool theory, is that there's someone who's willing to pay more, $30 for every dollar of earnings, than what you did, which is $20 for every dollar of earnings. I hope that makes sense. It's fundamental to understand how stocks work with price to earnings, because everything revolves around price to earnings. But, all right. So let's go back to this now. If we bought a stock for 10 and it has $10, and we'll just say for every dollar of earnings now it's 20, and I sold it stock for 20 because you were willing to pay more in earnings for a dollar of earnings, and I just doubled my money. I hope that makes sense. All right. So PE effects reaches beyond earnings and capital gains, though. It does. It exerts significant control over dividend yield. As it turns out, the reinforcing results end up being in favor of PE's other effects. The chart below shows a high correlation between PE ratio and dividend yield. I talked about this yesterday in my thing on dividend yields. The higher the stock price, the lower the yield. There's no other way around that. And what you see here is the PE ratio is plotted on this axis, and the dividend yield is plotted on this axis. So the higher the PE ratio, the more expensive the stock, the higher the price is, the lower the dividend yield. The lower the price to earnings are, i.e. the lower price of stock, the higher the dividend yield. The resulting patterns provide insights about the relationship across a full range of conditions. High PE is closely associated with low yields, and low PE coincides with high yields. Literally, these two things it's a seesaw, man. One goes up, the other goes down inherently. This is one of those rare instances when correlation reflects causation. PE is the relationship of price to earnings. Dividend yield is the relationship of dividend payments to price. I talked about this yesterday. I cannot stress this enough. If it's a high dividend, it means there's a low price. If it's a high dividend yield, it means it's a low price. If it's a low dividend yield, it means it's a high price. Therefore, with price as a variable that both ratios have in common, we can mathematically eliminate it for comparison and recognize that PE and dividend yield actually reflect the relationship of earnings to dividends. So when you're looking at things like valuations, price to earnings, price to book, or dividend yield, you can scratch. Everything's based on price to earnings. You have high price relative to dollar of earnings. Everything else will be secondary. That's all there is to it. You're going to have a low dividend yield. You're going to have a high price to book. Some dividends are paid from earnings, and since the share of earnings paid as a dividend varies in relatively narrow range over time, we see a close relationship between the two ratios. Valuation drives dividend yield. For example, the same dividend amount when price is based on PE at 20 has twice the yield as the price is based on 10. I put a link to show us the video I literally just did on this yesterday. I didn't expect to do this video here today on this, but it's so critically important. I just want to show it again. Dividend yield is over on this side, on the horizontal. Price to earnings ratios on the vertical. The higher the price, the lower the yield. Notice you got a high yield over here. Let's say 6 and above, but nothing breaks 15 from a PE ratio. Nothing. Anything else I want to talk about this? In the short run, this Ben Graham says, in the short run, the market is a voting machine. In the long run, it's a weighing machine, weighing the price to earnings of stocks, and it weighs earnings. I mean, so the lower the earnings, if earnings are declining or earnings are flatlining, it's going to be tough to make sense to increase your price to buy the shares because earnings are going down or earnings are flatlining. You're going to make hard justifications, say, earnings are dropping, I'm going to buy more for $1 earnings. And so the issue that we have here is valuation. As a lot of people say, low valuations mean stocks are riskier. I think of the other way. High valuations mean stocks are riskier because then you're assuming someone's going to pay a higher price than the high valuations that they have now. All right. Hope this makes sense. I'll put a link in the show notes. We'll see you next time.